going? My name is Greg Michalowski, folks. I'm the Chief Currency Analyst for FXDD, and I am here today as a guest of FX Street to talk about trading the trends. Before we get started, let me remind everybody that trading is risky, that you should only use risk capital that you can afford to lose. Also, that during this webinar, don't intend to give any buy, sell, or hold recommendations. So please keep those things in mind as we go through this webinar here today. Once again, I do want to thank the people at FX Street for this opportunity to be able to speak with you today about trading the trends. And so let's get started. Now, what do we know about trends? Well, what we know about trends are this. They are fast, they are directional, and they tend to have larger ranges than most people think. That is how I define a trend. Fast, directional move, and oftentimes with that larger range than most people think. And that is important in understanding those dynamics or those characteristics of a trend. So, because a lot of retail traders get in trouble with trending markets. In fact, if I were to ask, or if I were to characterize a single thing that retail traders don't do well, and that is trading the trends. Most people think that because they learn the trend is your friend, all this, that you're supposed to stay on the trend, that is what they actually do. But I ask you all, in a month where we saw markets trending, particularly the euro versus US dollar trend to the downside, the pound sterling had a slower start than the euro, but started to pick up momentum last week, trending. We saw those people in Europe. We saw gold trend to the downside and then trend back up to the upside. We've seen Aussie and we've seen the New Zealand dollar trend to the downside. And all these markets trended this month in May, and it was a kind of a contrast to the prior 2 months. In the prior 2 months, what did we see? We saw more of a non-trending market. So my question to you out there as listeners is, how have you done this month? Have you made good, if not almost record trading profits for this month? And you should have. Why? Because trends, the market trended, and they're fast and they're directional. They have large trading ranges, so you only have this the ability to make money. So I'm getting the question: is there sound? There should be sound. Who hears me out there? Hear me? Checking. 1, 2, 3. Checking. 1, 2, 3. There's here. Okay, Alex hears me. Boyke doesn't hear me. So maybe your internet connectivity. So I will continue on here with my presentation. So again, ask yourself or go back and look and see, how did you do this month in comparison to the prior 2 months when the market was more non-trending? And if you did really well, then okay, you're doing your trading trends fine. But if you didn't, then you have a problem with the trends. You got to start to focus a little bit more on trends. What else do we know about trends? And what we know about trends is this. I'll turn up my sound a little bit, Maud, and see if we can get the right sound here. It seems like we're going back and forth, too loud, too soft. But what we know about trending markets is that trending market will transition to a non-trending market, and a non-trending market will transition to a trending market. So when we go back to those prior 2 months before the month of May, what do we have? Non-trending markets, and those non-trending markets transition into a trending market. That is what okay, good. We seem to be right now. So that is what I try to look for. I try to look for these non-trending markets, and sometimes it takes a while for it to turn into a trend. But when the month of May started and we started to move outside of the trading ranges, it was a real good clue that this market had the potential to trend pretty far. That's what you as a trader have to do. Now, I have a confession to make, and that is I personally don't know how far the trade will end up going in the direction of the trade or the direction of the trend. Whenever I put a trade on, I don't know how far it will go. But what I do know is that if I define my risk and if I use the least amount of risk, that is, I don't trade when event or liquidity risk is too high, my target is relatively easy hurdle for me to reach. And so I look at trading from the standpoint of looking at risk first, and then look to see if the trend starts to develop, if this trend starts to move in my direction. And if I can anticipate a trend from a non-trend, so the market's non-trend, I anticipate a trend from a non-trend, what can I do? Then I can start to I'm more likely to stay on that trend. But I really don't know how far the market is going to trend, how far it's going to go. But I do know that if I define my risk, if I limit my risk, it's going to be my targets in this trend are going to be relatively easy hurdle to get over. What I do also know that is if I focus on what I call borderline entry levels that are visual to many, and energy at that level area or slash area should make me wrong. Should it make me wrong, I'm going to lose a little, or right, make me make more than a little. So what I'm going to do in a non-trending market is look for levels where I can define my risk, where I can limit my risk, and that occurs at what I call borderline levels, levels where it's bullish above, bearish below. And if I can focus on those levels from technical tools like moving averages, trend lines, Fibonacci retracements, what I'm able to do is know that an energy is likely to develop at that level. So either I'm going to be right or I'm going to be wrong. If I sell against a level that is a nice borderline level, I'm going to be right if the market starts to go lower. And I'm going to be wrong if the market goes above that trend line, above that level. And I would expect that if it goes above that borderline level, that the market has an energy to the upside. Just like I would expect that if the market goes below that level, there's going to be an energy, or stays below that level, there's going to be the energy to the downside. So I'd like to focus on the borderline levels, and I like to define my risk and limit my risk. And what I also know is that if I can anticipate a trend by using the clues from the tools, using things like moving averages, Fibonacci retracements, trend lines, and I can understand that the market is in a non-trending type mode, like it was in April, like it was in March, that eventually the market's going to trend like it has in May. And so if I see these non-trending type months, I can be better prepared to expect or anticipate a trend. And then if you anticipate something may happen and it actually starts to happen, that changes your whole perception of how you're going to trade that trend, doesn't it? If you think that the market is going to trend because it's non-trending, you have a better chance to stay on that trend. Starts to move lower, you stay on it. You don't get out, with a 20 pip profit, a 50 pip profit, or maybe even a 75 or 100 pip profit. Maybe look for those opportunities to stay on the trend. Maybe if you get out of your position because, let's say, you don't want to risk overnight, you look for those opportunities where the market corrects, and then you go with the trend back in the direction of where it's going because you're anticipating a trend to happen. And a trend is not, remember, a trend tends to be larger than we think. And so that is what, so you have that idea that trends are fast, directional, have larger than you think, move in ranges larger than you think. And you start to think in terms of this market has 400 pips of trending in it. And that changes your whole perception of how you're going to trade and how you're going to trade the trends. well. So I want to take a look at the euro versus US dollar, and I want to take a look at it from this is a monthly chart here, and I want to go back to, or I want to look at what is the average true range. Just ATR is short for average true range. And what do? I put in 1 as the average true range. And so when you put in 1 as the average true range, what does that tell you down here in this graph? Well, it tells you that the average, it tells you what the range is for each of these specific months. So if you have the average true range 1, it just tells you the range of that specific month. And that I like to use and look at average ranges over time periods to gauge the trending or non-trending nature of the market. And I'm looking for those extremes where the market is non-trending typically. Why? Because non-trending markets transition into trending markets, right? And so if you know that the average true range over a month's time period is very narrow on a historical basis, what can you expect might happen? Well, that it's going to not be narrow going forward, or for maybe a month, or maybe even 2 months, or maybe even extended. Remember, I don't know how far the market is going to trend. All I know is if I follow my tools, if I define my risk, if I limit my risk, I have the chance for to get on this trend and for have the market move in a directional bias my favor. And I could make a lot of money in a fast and directional market. So what did we have here in the month of March and April? This down here is a flat line here where the market ranges for those 2 months, this one and this one, was around 377 pips. It's called 375 pips from a low to high trading range for the month for those 2 months. And so if you look at that in a historical context, and you start to go back and you look at, well, in one of the months in 2011, this is 2011 from here to here, we had a range that went down to 236, but that was only for 1 month. And so you can see that for all of 2011, every month had ranges much higher than 377 pips. In fact, most of the ranges were, above this 641 pips for a month. So that's interesting to know, from a historical standpoint last year. And then you go back to 2010, and nothing got anywhere close to what it was our last the month of March and April ranges. The ranges were well above the 375 pips, weren't it? It was like 500 pips was the in fact, maybe even 600 pips, somewhere between 500 and 600 was the low ranges for every month in 2010. And you go down to 2009, and we had 1 month that approached that 377. The rest of them were, again, well above the 370 that we had in the last 2 months. You go to 2008, same thing. Everything's above. In fact, look at this spike. We had a month's range at 2,000 pips to the range. But if you go back to this area right here, we have more of a risk-defined area of ranges. It's less volatile than these periods that we saw in recent times. So maybe this year is congruent with this type of area. But even so, during this period going all the way back to 2002, we had just 1 month here, 1 month there, no months in the month of March. We had a few little months here. This was a more non-trending type year. Going into 2007. And so, relatively speaking, what we saw in the month of March and April was historically very non-volatile, non-trending type ranges, or trending type markets, and also very narrow trading ranges. And that that to me is the time where I want to get excited about the market, to start to think toward the possibility of a trending market and see what happened, and then trade it that way. Trade it as if as if I knew that a trend was coming, and that is very important for you as a trader to be able to do that. Now let's take a look at another graph here, and this is a graph of the major currency pairs. 1, 2, 3, 4, 5, 6 major currency pairs. It's euro. I don't have the. Let's see. What am I missing there? New Zealand. Okay, so we have the major six most major currency pairs. And another thing that is interesting for the current market, or for the market that we've been, for the current market for 2012, is if you take a look at the euro versus US dollar as an example. This bottom line represents the current year's trading range, and it's 864 pips. That's from the low to the high. Our low is reached in the month of January, and even the last move to the downside here, our low that we reached last week, didn't get to that low price at 126, what is it, 23 level, I think. And so our range for the year remains at 864. Now, if you take a look at the ranges going back to, I think I look back to 1997, and if you look back at the yearly ranges, the narrowest range from the low to high has been 1,242 pips. The largest range for a year has been 3,707 pips, and the average range has been 2,175, and the medium range is 2,082. So our 864 pips for this year. Now it's May. We're halfway through. We're more than halfway through the month of May. We have, we're not even halfway through the year, so we have a long time to go. But when you come into the month of May and you're in this narrow trading range, we've had 2 months of non-trending markets at historically low levels. It's time to think that maybe this market has potential to start to trend, right? I mean, you just have to start to put the odds of success in your favor. And so even if the market trended, and it did, and it trended down to our low for the year, which it did, basically got within 20 pips or so of the low for the year within this we're still at a very narrow trading range, 864 for the year. So, coming into May, there is a lot of room for the market to start to trend either to the upper extreme or to the lower extreme, right? If it stayed within the boundaries, this would be the most narrow trading range in the euro's history, okay? I think going back to 1999. So that is, I typically don't trade with the idea that history is going to be made. Now, it may be made, but it may not, or the chances are it's not. And so that also is another indication that perhaps this market had a potential to trend by looking at this. Got a question here from Alex, and can we find these statistics somewhere in the public? And what I did is just did some homework on MetaTrader. We use MetaTrader at FXDD, and so you can go in and you can just go back in time and put up a monthly chart and figure out what the high and the low trading ranges are for the calendar year. And so that's a way that you can do it. Start your own little Excel spreadsheet and just keep it up to date. It's not like these ranges are extended, but you can easily do that for your currency pair. But which brings up a point, folks, is that sometimes trading you have to take those little extra steps along the way and try to put the odds of success in your favor. Another way you can do it within MetaTrader is there's a way that you can extract data into an Excel spreadsheet. So you can go in and you can get the data from Excel. I don't necessarily want to go into it just now, but if you have any questions in regard to that, and your customer have FXDD, just call up one of our customer sales representatives, and they'll probably put you in touch with someone who can help you do that. But you can extract data from the MetaTrader platform into an Excel spreadsheet, and once you have that data in that spreadsheet, you can go back and use Excel. What is the maximum for this year? What is the minimum for this year? And then figure out the ranges. Boyke, I think this goes back to 1999. Looking back at the historical ranges, going back to that year where the euro started its trading. All right. So, all right. So now let's look at the euro versus U.S. dollar, and this was the daily chart going back. Well, it's not up to date. It's about a week old or so. But what I wanted to to look at is when we're looking at the end of April, again, April and March were very narrow trading ranges. In fact, they kind of mirrored each other. It went down and then went up and then went down. We started the month at the high, went down, and then went up toward the middle. So we kind of did a mirror of each of the months in the ranges. In any case, when we're looking at the month of May, we're up here at this high, near the high. So that might suggest that the price has the potential to further trend to the upside, doesn't it? If we're able to break through this trend line, and this trend line had 1, 2, 3, and this was the fourth spot right at the top. Now we also had a nice little trend line along the bottom with 1, 2, 3. We had a failed break, if you can see right here, a failed break below that line here. But fails happen in trading. This should have sent the market further to the downside, but it didn't. And when it didn't do that, and in fact it closed above this trend line again, I keep the same trend line in place. I keep the same integrity of that trend line in place, and you can see that the market, what did it do? It rallied. It didn't look back at that line again. It kind of used that level as support, and it went back. And where did we go? We went up and tested our topside trend line there, and at the beginning of May, and the market then, as we know, started to go up. But what we're looking at in May was a decision time for the euro versus U.S. dollar. Did it want to go to the upside, or did it want to go to the downside at that point? And so it was a key time for the euro to make a decision. And once again, we're looking for a trend type move. Now, what I also like to do analysis is not just look at those at the daily chart, to make a projection of, we have the potential to trend, but I also like to look at shorter term time periods. In particular, I look at the 5-minute, I look at the hourly, and look at the daily chart. And what I'm looking for is what I call these borderline levels where you can define risk and limit risk, where you can risk a little with have the potential to make more than a little. And if I do that, and if I'm anticipating a trend, then I can risk a little and make way more than a little if, in fact, the market does trend. That's what you as a trader, are looking for. Those types of trades are the ones that are going to make your year. If you had the opportunity to make your year in May because of what happened in March and April and the potential for a trend. We don't know how far it would trend once again, but the potential exists for you to make your year. They come a couple or 3 or 4 times a year for you to do this, and that's when you as a retail trader really have to be on the ball, be on the lookout, and try to make your year in these trending markets where the most amount of money is made. It's also where the most amount of money is lost. So let's go to the 5-minute chart and take a look at where the price was on this day, May 1st, where the price started its trend to the downside. Now we know it started its trend to the downside, but let's play what if that we didn't know, what was going to happen, because we don't know what the future is. All we know is that we have the potential for the market to trend one way or the other. And when I look at this 5-minute chart back then on May 1st, I saw this spike to the upside, and the market's trading at 132.67. The 7's not showing it, but it's around the 67 level when I took this picture. Now, I'll give the caveat a little bit later about what this day was about. But the 100 bar moving, when I look at a chart like the 5-minute chart, when I look at the 5-minute chart or the hourly chart or the daily chart, I don't have a position. I know there's good, I want to find what I call the borderline levels where I can lean against, where I can define my risk, where I can limit my risk. So I look for borderline or levels that are what I call in play. If the market gets through a level, either a top side resistance, a top side trend line, or a bottom side moving average, a Fibonacci, a trend line, a moving average, a Fibonacci, maybe some lows here, maybe this low right here. All these levels are borderline levels that give me a bias either bullish or bearish, aren't they? And they define the way or the route, if you will, or the direction that I'm going to take. Imagine you're on the highway and you're going to Grandma's house, okay? And Grandma's house is at exit 06, okay, down here. Well, to get to exit 06, 132.06, you have to get through this exit right here at 60. You have to get through this exit here at 53. You got to get through this exit here at 50. You got to get through this exit at 44. You got to get through this exit at 35. And then you're on the open highway and you have the potential to get down to this 06 level. That's the way I like to think of it. That's the way a trader's I think that successful traders think about taking those steps. They don't necessarily see the entire move. Yes, you can target this 06 level on this particular chart, but in order to get there, you got to get through these other support levels that are against key technical levels. So the blue line is my 100-bar moving average. That comes in at 59. The 38.2% retracement comes in at 53.4. That's or it's actually 53.3. The trend line that comes off here that has 1, 2, 3, broke a little, failed, came down to 200, moved back above it. That trend line remains intact. So I'm going to use that too, and that's right at the 53 level. And the 200-bar moving average is all at 50. Doesn't matter that all these levels are within 9 pips here, and that I've outlined each of them. No. That says to me that there's a lot of support between the 50 and 59 level. In fact, going down to 44. If it gets through these walls of resistance or support, then that's good. That's good for this trend moving from upward, which we're seeing here, to downward. It's breaking down those walls, those barriers along the way. And even if they're 5 pips apart, 2 pips apart, or whatever, that is good. That's good news for your trade to be able to get through those levels. Now on the top side, in the borderline levels were obviously this top side trend line, 1, 2, 3 different points. We broke above it and failed and broke back down below it. And so that's a key level. And then the high price at the 82 level, we know that level is an important level off of the daily chart as well. So let's now take a look at the hourly chart and see what borderline levels are in place on here. And in our 5-minute chart, we were just looking at basically this day right here. Let's go back to it. This is one day, and we're looking at the half of the other day. So now let's go to the hourly chart. We're looking at this and this right here. And what we see, if we move back just a few more days, we can draw a trend line here, 1, 2, 3, 4 different points on there. So just like on the daily chart, our hourly chart showed some nice resistance up here at our 82 level. So that's a key borderline level. So not only is a key borderline on our daily chart, and by the way, that's not the same levels here where you had 4 points here. This is from a downtrend going all the way back to the start daily chart again, going all the way back to the month of beginning of February, and this is March, and this is April here. So we had 4 spots on the daily chart coming down that dissected across that 82. Then we had our 5-minute chart. Now we have our hourly chart, and we have 1, 2, 3, 4 spots along there. So in the 82 level or 83 level, 132, up there at the highs, that's a key level. On the daily chart, it's a key level on the hourly chart for 2 different reasons, but there's the same technical, basically on a trend line. It's the same borderline level. So that level is key. We move above the 83 level, this market's going to the upside. We stay below it, and guess what? This level's not going to the upside. It has a potential to go to the downside, right? And the fact that we know that it's non-trended 2 months before, and we have it's time to move, or the potential exists for its time to move. Now, on the downside, on the hourly chart, we have the 100-hour moving average. This is the blue line, still represents 100 in my analysis. I just use 100 and 200 bar moving average, and depending upon whether it's an hourly chart or 5-minute chart, it's 100 hour in this case on the hourly, and the 5-minute chart, it's 100 bar on the 5-minute chart. So that's what and on a daily chart, it's 100-day moving average. So anyway, 132.28 is the 100-hour moving average. 132.04 is 200, and 132 even is the trend line here. This trend line connects 1, 2, 3, or close to 1, 2, 3. Kind of fell short here and moved up to this 3 level. So what do we see? We see 28, and we have 132 to 132.04. So those are key levels around the 132 level. And 131.56 is our low for the week. The weeks of the last week of trading, 131.56. So 28, 04, even 131.56. So those are the borderlines in play on the hourly chart. And of course, we know on our daily chart, I outlined 4 on that original chart. There's really more levels along the top. I mean, it tested this top side trend line a number of different times, and we reached this high right here. We have that top trend line at the 80 level. We have a 100-day moving average at 131.17. That's the blue line in this chart, and then we have 130.72 here on the downside. So with that in place, we know, and on the top side, I guess, what do we have? We have this 134.66. So if it breaks above the 132.80 level, we can be pretty much, we would know that if there's something that forces this market above the 82 level, and we're expecting a trend, that this is going to trend to the upside, and then this 134.66 level would probably be in play or a target. We'd have these tops as well as 133.50. That would be a target. We'd have this top, which comes basically around the 134.66. So I would see the market going up toward the 134 level or 133.50 level, and then toward the 134.60.50 level on the top. That would be the target to the upside. If we are able to get above the 132.82 level, should open the door to the upside. On the downside, if the market does not get above that 80 level and we're at this resistance level, there's only one way, folks. Either it's going to stay here and stay non-trending, or we're going to trend to the downside. We have a good chance, a better probability that this market has a potential to move to the downside. And so we're at a key point. I like to say that the market has a decision to make. That key resistance up there is a decision time for the market. The market has to make up its mind. What does it want to do? Go higher or go lower? So you're on full alert at that point. You're in red alert at that time. It's time for you to think in terms of what's going to happen. Now we know what happened. The market ended up breaking lower. And what was the catalyst for this break? Was there a news item that happened on this day, May 1st, that caused the market to break to the downside? And I have to tell you that there was the FOMC interest rate decision on that day. And some of you say, well, oh, Greg, I didn't want to take that risk through the FOMC decision. And folks, you didn't have to, okay? What you had to do was be aware of all the things that occurred before, all these borderline levels from the 5-minute chart. You needed to know the borderline levels from the daily chart. You needed to know the borderline levels from the hourly chart. And you needed to know that 132.80 was a key level on the top side. And on the downside, what you needed to know was basically going to the 5-minute chart. If we can break through this cluster of support between the 44, the 50, the 53, the 59 level, if it can break through and stay below those levels, we're going lower. All right? It's 30 pips away, or less than 30 pips away from the 82 level. This thing is going to the downside. You have to make that judgment, and it comes from knowing your borderline levels, understanding what the market has been doing, and understanding that the market has a potential to trend, and understanding also that this news event, this comments from Bernanke at the FOMC at 12 o'clock, leading into Bernanke comments later in the afternoon, had the potential to move this market to that downside. So what actually happened? I put this on a 1-minute chart just to show you what the how the price action went. And keep in mind our key levels between the 44 level and the 59 level. And what we see on this 1-minute chart is that the market indeed fell sharply from our, we spiked up before the FOMC decision was at around the 67. The market fell down sharply here, and we came to this 38.2% and trend line in the 5-minute chart at the 53 level. Remember that level, the 53 level? The market came down to that level and stopped. And then it went up, and where did we go? We went right up to the 59 level right here. The 100-bar moving average on the 5-minute chart comes in at 59. Let's go back to that chart right here. That is this point right here. So we came down, went down to our 53 level, this trend line, and this 38.2, and retraced to this 59 level. Well, folks, that is an opportunity. That is an opportunity to take advantage of those early buyers out there, not you, those buyers who aren't anticipating a trend, who don't realize the importance of the 82 level from a daily perspective, from an hourly perspective, and they are the ones who sit there and take the profit here. They force the market up to the upside, and you as a trader have to be prepared to get in this market. Even if you sold at 59, 58, 57, and you put your stop at 82 or 84 on the top side, that's still a good low risk-reward trade. In fact, you don't even have to go that far. You can just put your stop up to around the 72 level and say, this is where I want to be in. But it all goes back to that idea that you're waiting for something to happen, and the news comes out, and Bernanke and the Fed say that they're not going to do QE3 or whatever, and the market starts its move to the downside, and you're prepared for that, and the market moves up to our 59 level, and even if you don't get it at 59, if it breaks to the 53 level or breaks to the 44 level, you have to be on that trend. You have to be on that move to the downside. But the higher you can get, the better off you are. And from that point, you are in control. You are in control of of this trade because you don't have any risk. Your risk is a small amount. You can risk 20 pips, 25 pips on that trade, but with the firm understanding that, and the firm confidence that this has a potential to trend in the direction where you go. So what happens? The market goes down to our 100-hour moving average and stalls a little bit. A really small bounce to the upside, breaks to that level, and we come down to our 200-hour moving average at the 132.04 level. Let's go back to our hourly chart. Take a look at the 100-hour moving average at 28. Remember our 200 and our trend line at the 132, even 132.04 level. So the market is really going from level to level to level. We go to the 28, we go down to our even to 04 level. The market stalls at the 03 level. Am I surprised? No. Those were the levels in my charts. Those were the levels that I mapped out. My route to Grandma's house went through 53, went through 59, 53, 44, 28, even. And that brought me to Grandma's house. So we made it to Grandma's house pretty quickly down to the bottom side. And then we start to just do this correction. And at that point, I'm going to put in my Fibonacci retracements because this move is unsustainable to the downside. Now, in a trending market, folks, what typically happens is that the market will trend in a directional bias, and then we'll get those corrections. And what I look for in a trending move, especially a trending move that I'm anticipating a trend or a fast move, a fast direction move, and in a fast directional move where I am anticipating a further trend. This doesn't do it, okay? Going from 82 to even does not do it. That is not my definition of a trend. So what I try to do is then try to measure the corrections and see if the market can hold certain retracement areas. And what I try to look for is that the trends hold the 38.2 to the 50% correction. If it can hold the 38.2 to 50% correction, that is what I call the correction zone. And the correction zone to me says that if you hold that level, then the sellers, those people who aggressively sold the market here, are willing and able to sell again on sale when the market comes on sale by 38 to 50% off. They are at Macy's, that's a department store here in the United States, saying, I am more than willing to come back in here in that correction zone. I am happy to sell at this lower level, or at this higher level in this case, this discounted level, and I'll put my stop above the 50%, or I'll put my stop, I'm going to sell at 42, I'm going to put my stop at 52. Wouldn't that make sense to put my stop above the trend line that broke in the 38.2% retracement that broke right here? That would be a level that you would put your stop in. So again, sometimes you have an opportunity in trends, or you do have opportunities in trends to trade against the correction zone, trade with that level in mind. So if you miss this sell up here in this area, you can get it again here with the same type of risk, 42 to 54, 55 and 59. So you're risking, 15 pips on the trade. I would do that in a second, especially if I'm expecting or anticipating the potential for a trend. So when it holds a correction zone here at the 38 to 50% retracement, that says to me that the sellers who force the market to the downside are more than willing to get back in. What does it say about the buyers? The buyer who bought down here, right here at Grandma's house, at the exit on Grandma's, for Grandma's house at the 132 level, has a nice gain here. But he also sees that we can't go any higher. We can't get above the 50% of this move to the downside. And so he starts getting nervous. And the guy who bought here starts getting nervous. The guy who bought here starts getting nervous. And the guy who bought here and here and here, they start getting nervous because, the market has a potential to trend. So what happens? The market goes up to that 50% level. And let's look at instead of the 1 minute chart. Remember, I don't look at 1 minute charts typically. I look at 5 minute charts. But what is the 1 minute 200 bar moving average saying at this 50% level right here? Well, we have the 200 bar moving average on the 5 minute chart. And look how it moves sharply to the downside, corrects back up to the 50%, and runs into this 200 bar moving average. And we stay above the 100 bar moving average, but we run into the 200. We break below the 100. We run into, now this thing's starting to turn this way. We run into the 100 and the 200 right here. We run into the 100. We run into the 100 and the 200 right here, and we get that second break to the downside. We finally are able to get through Grandma's exit and start to move to Mary's exit down the road. Aunt Mary's exit. She makes the turkey. So we're going there for dinner. So we head down, and we start to break through to the downside. And where does the market go? This is our first day. Where does the market end up? Well, the market ends up less than 24 hours later, down at within a few pips of the 100-day moving average of 131.18. That was our 100-day moving average. That was this level right here, the blue line of the chart. It moved from our top right here down to our 100-day moving average down here at the 131.18 level in a directional bias to the downside, and that's where we ended up. Now let's to end it up here. That was just the beginning of the trend, but that, my friends, is the most important part, because if you're anticipating a trend, you want to see that market do those things that turn the bias from bullish to bearish. So let me take off my screen here, and then I'm going to put it back on my charts. And let's just do the hourly chart, I guess. And, go back in time here. And let me get back on the screen here. There we go. All right, can you see my hourly chart there? Can someone give me a yay? Okay, sorry, we must finish. Okay, we got to finish in 1 minute. But I assume that you can see the screen. Okay, you can see it. Well, what we see here in the trend here is where that first low is made. This is as far as we went in that trend, and that trend, that was a nice profit. That was a nice profit to get in on that trend. But once again, what we have to remember is that the trends are fast directional and going longer trading ranges. So that was not the end. The market consolidated here and then started to move back to the downside. And I'm going to just go through real quickly here and show the market holds that level. It starts to move down again. If you see the market holding that 38.2, use it as a guide to your trading. Here we have the market start to get close to the 38.2. We can't get through that level. Market starts to move lower. And just I'm almost done here. Then we're going to go to here to here. This is a trend type move to the downside. Look how the market not on the low there. There's a low. Look how the market came to the 38.2, held that level. We'll come down to our low right here. You don't need to measure the bigger moves. Measure the smaller moves along the way. If it holds a correction zone, everything's okay. The market is still trending. You're still getting the support from the market traders. Finally, we get to this point where the market starts to move up above the 38.2 and the 50% of this trend move to the downside. Trend's over, market starts to consolidate, and that's what we're seeing. Now we see the 100-bar moving average come into play. We hold above that 100-hour moving average here today. We test it and move back above it. So we're in this non-trending type zone. That's what you do in trending. So I hope you I appreciate your staying around here today. Sorry for the delay in getting started, but hope you learned a lot from our lesson here today. My name is Greg Michalowski, FXDD. Thank you very much, people at FX Street. Bye-bye now.